Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
Welcome to T-Hub Capital's The Investors Lounge weekly podcast. Today's date is the 22nd of June. Let's dive into the week's top market news. Geopolitical optimism drives gains. Central banks hold steady. During the four-day trading period ending Thursday, June 18th, the pan-European equity markets demonstrated resilient upward momentum, with the benchmark stocks Europe 600 index finishing up 0.62% in local currency terms. This regional optimization was largely underpinned by shifting geopolitical dynamics, as market participants reacted favorably to the breakthrough news that the United States and Iran had successfully negotiated and signed a memorandum of understanding. Despite this overarching geopolitical optimism, incoming macroeconomic data painted a highly nuanced and mixed picture across different European jurisdictions. Performance among the primary domestic stock indexes diverged notably, with Germany's DAX advancing by 1.59%, France's CAC 40 index climbing 1.40%, and Italy's FTSE MIB leading the continental pack with a robust gain of 2.31%. Conversely, the United Kingdom's FTSE 100 index completely bucked the regional trend, underperforming its continental peers and slipping by 0.69%. Eurozone trade dynamics and macro headwinds. On the macroeconomic front, the Eurozone's trade architecture encountered unexpected friction. Fresh data revealed that the region swung into a €1 billion trade deficit for the month of April. This sudden deterioration stood in stark contrast to the comfortable €7.8 billion trade surplus that consensus economic models had originally anticipated. Corporate and financial analysts attribute this deficit primarily to a structurally widening energy trade deficit, paired with a tightening contraction in the export surpluses typically generated by the high-value machinery and vehicles categories. German inflation moderation and sentiment rebounds. In Germany, the underlying data suggested an encouraging macroeconomic stabilization as wholesale price pressures began to thaw. German wholesale price inflation rose 5.9% year-over-year in May, marking a definitive deceleration from the 6.3% rate recorded in April. The primary drivers of this persistent inflation remained heavily concentrated in petroleum products, non-ferrous ores, metals, and associated semi-finished goods. In contrast, the consumer side found immediate relief as the wholesale prices of essential food commodities, including coffee, tea, and milk, observed a notable decline. This cooling inflationary backdrop, alongside broader economic resilience, catalyzed a sharp recovery in institutional confidence, causing the ZEW indicator of economic sentiment to surge dramatically in June 2026, marking its very first positive reading since the outbreak of hostilities in the Middle East. Monetary policy stances and central bank caution. The central banking landscape remained anchored in a posture of watchful caution as monetary authorities assessed the systemic impacts of global conflicts. Moving in lockstep with widespread market expectations, the Bank of England opted to maintain its benchmark base rate steady at 3.75% during the meeting of its Monetary Policy Committee on Thursday. Although annual inflation in the United Kingdom held flat at 2.8% in May, hovering at its lowest level since March 2025, policymakers openly conceded that forecasting future price trajectories remains exceptionally difficult due to the ongoing price distortions caused by the Iran war. Internal structural data showed that cooling expenses in housing and household services were entirely offset by accelerating transport inflation, which directly reflected higher fuel costs and airfares. In adjacent European monetary jurisdictions, a similar wait-and-see philosophy prevailed. The Swiss National Bank left its key policy rate firmly at 0%, making virtually no material alterations to its long-term forecasts for economic growth and inflation. Meanwhile, Scandinavia's Norges Bank also elected to keep its policy rate unchanged at 4.25%, but adopted a significantly more hawkish tone. Norwegian policymakers explicitly signaled that a future interest rate hike remains highly probable over the medium term, given that domestic inflation in Norway continues to run stubbornly above target thresholds. Now our insight into alternative markets, AI and private equity, between promises and financial results. Artificial intelligence has become the dominant topic in conversations among private equity general partners worldwide. Every pitch deck, every management presentation, every investment thesis now references AI as a value creation lever. Yet when we move from narratives to measurable effects on EBITDA, the picture that emerges is significantly more sober. A recent survey conducted by Alvarez and Marshall across 100 executives from large-cap and mid-cap funds, together with their respective portfolio companies, offers an unsparing snapshot of the current state of play. 73% of respondents expect AI to increase the value of their portfolios over the next 12 months, yet only 8% describe themselves as leaders, meaning AI is already generating a material impact on EBITDA or meaningfully shaping their exit narrative. This gap between expectations and results is not trivial for those of us who value companies and build investment theses. It means the market is pricing a promise, not yet a performance, where adoption is concentrated today. The operational reality shows that the vast majority of AI initiatives within portfolio companies are focused on back-office automation. The most widespread applications revolve around financial planning and analysis, cited by 55% of respondents as the primary use case, alongside automated invoice coding, accounts payable management, operational report generation, contract management, procurement optimization, and the automation of repetitive administrative processes. As Anil of Alvarez and Marshall puts it succinctly, AI is certainly an efficiency driver, but operational efficiency, however valuable, is not sufficient to justify the premium valuations that the market today tends to assign to companies with a declared AI strategy. The structural problem: individual productivity versus P&L impact. The critical point emerging from the analysis is a fundamental distinction that every investor should keep in mind during due diligence. There are two profoundly different levels of AI adoption. The first is individual productivity, where a single analyst or financial controller uses GPT-based tools to speed up their daily work. The savings are real, but remain confined to the personal sphere and rarely translate into a measurable line on the income statement. The second is systemic P&L impact, where AI is integrated into business processes in a structural way, for example by accelerating the accounts receivable cycle, reducing working capital, optimizing dynamic pricing, or enabling entirely new revenue streams. Christy Carter, global head of BCG's PE sector, captures this dichotomy with precision. Using AI to drive accounts receivable faster and reduce working capital is fundamentally different from having an individual employee using GPT to make their day easier. These are two completely different things. Implications for value creation at exit. For a private equity fund, the question that matters is not, does this portfolio company use AI? But rather, is this company's AI already in the P&L, or is it still a pilot project? In our experience, this distinction becomes critical at exit when building the narrative for potential buyers or preparing for a listing. A sophisticated strategic buyer or another PE fund will know how to distinguish between AI as a real asset, with demonstrable KPIs such as DSO reduction, conversion rate improvement, or lower cost per transaction, and AI as a story, still in the experimental phase, with ongoing pilots, but no verifiable impact on free cash flow. The first category deserves a premium multiple. The second risks being recalibrated downward during due diligence, where the true potential lies. The real competitive advantage of AI and PE does not lie in back-office automation, which is necessary but not differentiating. It lies in higher impact domains. Revenue generation through AI-driven pricing, offer personalization, and commercial funnel optimization. Competitive repositioning by anticipating market dynamics and redefining the service model in a structurally superior way, and the construction of a credible exit narrative that demonstrates to buyers and investors that AI is already embedded in core processes, generating measurable and defensible advantage over time. OUR perspective. At THUB Capital, we are closely monitoring this transition. Our thesis is that over the next 18 to 24 months, a clear bifurcation will emerge in the PE market. On one side, portfolio companies that will have successfully transformed AI experiments into value-generating processes. On the other, those that will have consumed resources in pilots that were never scaled. Our approach to screening and due diligence now incorporates specific AI-focused questions, not just what are you experimenting with, but where is it already in the P&L? And what is the plan to move AI from the back office to the revenue engine? Because in a market where only 8% of companies are already reaping the rewards, the remaining 92% are still in the race, and the window to position correctly is closing.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.